Hello and welcome to this episode of To The Point. I'm Neil Stanley, and today we're going to talk about expectations for the Fed fund target rate. So the FOMC is the party that sets the Fed fund target rate. They do this not as a dictator, but as an entity that guides the interest rates, that sets the rates between banks. So if two banks, one has excess funds, the other one's short, this is the rate that they're controlling between banks. And that is a rate that is data dependent. They say this all the time. We need to believe them when they say it's data dependent. What that means is they don't set the rate and just say, well, whatever happens, happens. No, that rate impacts the economy. And the economy is something that they have a mandate to manage. They are to promote two things: price stability and full employment. And so as the rates move, it affects both of these things. And there's a tension between raising or lowering rates and the things that happen with the inflation and the unemployment. There are 8 scheduled FOMC meetings a year. You can learn more about it at this link. I always try to give you links, as you know, in our material here so that you can do research on these topics in addition to the material I share with you. Here is a graph of the economy. The big picture is all about GDP, unemployment, and inflation. And so you can look at this link. It'll keep you updated with the current status if you pull that a link of that or access that link. So one other thing that we really must think about is what has the FOMC predicted with the rates into the future. So this was the report as of June of 24. And so we're going to take a look at this. But before we do, we want you to know that they always say they're data dependent. What does that mean? The projections that they make are based upon the projections that they make for GDP, unemployment, inflation. And so they will predict, they will show you what those levels have been in the past, and they will predict what they're going to be for the end of this year and into the next coming 2 years. So we look at that data, and if you believe in their projection for that data, then you can trust their projection. It's going to be pretty accurate because they're the ones that are going to set the rates as time passes. So anytime somebody says, well, what's the longer rate forecast for the FOMC? And you see this data, it's based upon data that you can see in the previous slide. But I really am skeptical of some of these longer run numbers being in around the 2.5 level. Because if in fact you do believe that inflation is going to be at 2, history does not support having a 2% inflation rate and a 2.5% Fed funds rate. That combination doesn't make sense. It's going to be more like the 3.50 to 4% of some of the FOMC members that you see here. So I'm going to take a little time to expose this or to explain why I say that. The market is predisposed because of the most recent past to think that interest rates are going to fall. And we understand that, and I personally subscribe to that as well, given the circumstances today. If we look back 3 months ago, we can see that the market believed that we would end the year at around 509. Fed funds futures market are relevant. They are not accurate in any particular day, but they are relevant. And what they believed back then was that we would be in the middle of 25, we would be at a 477. So if we fast forward to today, we see that now the market believes that we're going to be at a 447 for the interest rate for the end of this year, for 445. And then next year, in that same date we had forecasted before, we'd be at 374. And by the middle of next year, we'd be at 344. Now, the interesting thing is there are some participants who are willing to bet in the futures market that we're going to be at a 250 rate by July of 25. So I simply want to temper this with a little bit of data. So I went out and I pulled the relationship between PCE inflation and Fed funds. So you can find this if you go to our website, and so I'll pull that up. If you go to resources and go to analytics, you will find that there's under downloads comparing Fed funds to inflation. There's a download there. If you pull up that download, you're going to see, and you can find that data, the raw data here at this link up in cell C1. You're going to see Fed fund rate going back into 1960, and you're going to see PCE inflation going back during that time as well. What we do then is we calculate a spread between Fed funds and PCE for every month of that time period. And if you look at that, the average Fed fund rate was 4.8 from 1960 to 2024. 4.8. The average PCE inflation was 324 and the spread was 156. Now the median, 50% of the time we were above, 50% of the time we were below, was 474. It actually might make a pretty good predictor of long-term Fed fund rate. Now inflation was 229 and we're kind of hoping to get back to that 2% level. If that was the case, we'd have a 160 basis point spread between inflation and Fed funds. That's historical median. Now, if you eliminate the Great Recession, why would you eliminate that? Any time period that past the Great Recession has been impacted by the idea that inflation can be above interest rates and it'll be okay. And so if you get rid of that, you'll see that the median spread was 263 rather than 163. In other words, they had to hold Fed funds much higher because the stigma about letting inflation get out of control, if you go back into prior to the Great Recession, that stigma was in place. So time will tell if this generation will be impacted by the stigma of inflation. But during the Great Recession, we weren't. Most participants believed inflation, thing of the past, no big deal. And so that period from 08 to 2024, we actually experienced inflation, PCE inflation averaged 164, the median was 164, but the median Fed fund rate was only 19 basis points. So that created a median differential of 112 below inflation is where Fed funds were. So if you think inflation is going to be at a certain level, maybe you think it's going to be in this 229, between 2 and 2.5, and you add 162 to it, you're going to be seeing interest rates that are going to be significantly higher than maybe is expected by the marketplace today. So going back to the slide, what do you think, if inflation is going to be between 2 and 2.5, where will the Fed fund target rate be? It's very hard to see it being below 250 in any circumstance, because the idea of being below 250 was one of these that was based upon a loan to deposit ratio that was so high that the credit was so tight, nobody could get credit. So nobody wanted credit, nobody could get credit. So, hey, it was okay to keep interest rates low, below inflation. But now, if you think interest rates are going to need to be maybe 150 to 250 over, and well, if your inflation rate is 2 and you need to be 150 over, that's a 350 rate. So you would say, well, maybe this 350 is right. But if you need to be more than that, you're maybe someplace between 350 and 450. I don't know that we need to be above 450 as we looked out before. That has been the median rate going back for 60 some years. But I don't know that we need to be that high. My sense is it's going to fall somewhere between this 3 and 450 rate is going to be kind of where we're going to be. Now, that's just one person's opinion, but I just wanted to share that with all of you as we transition from this Fed pushing rates up to having plateaued to now thinking about falling rates. Where's the floor? Where's that going to be? I hope you found this to be helpful, and I welcome you to schedule time if you have your own point of view, or if you want to know more about how I came up with any of this. Schedule time with me using my appointment application, and be sure to subscribe and turn on notifications so that you get every one of these YouTube presentations. I very much appreciate the opportunity to share this with you and look forward to sharing the next episode of To The Point. Until that time, make it a great day.